Good afternoon and welcome to Freight Forecasting. I'm Mike Vincent, Freight Forecaster here at FreightWaves, and joining me today, again back in the studio with me, is our lead economist or economist at large, Anthony Smith. How are you today, Anthony?
Yeah, I'm good. I'm excited to be back. Thanks for having me. It's always a blast here on Freight Forecasting.
It is certainly my pleasure to have you here. Your insights are wonderful.
Thanks for having me. Yeah.
Whenever we bring in like when I'm going to talk about really smart stuff, I need you here to support me.
I just say yes.
Not that I don't know what I'm talking about, but nobody else thinks that I do. But also joining us today is editor at large for FreightWaves, Mr. John Kingston. Are you there, John?
You really dragged that out, didn't you? Yeah.
Well, I wanted it to be dramatic. You're a big deal. I've said it before on TV that when John Kingston talks, I listen. He always has something interesting to say and very insightful. So I appreciate you being on the show, my friend. How are you?
Good, like E.F. Hutton, right?
Yeah.
When E.F. Hutton talks, people listen. I'm dating myself with that one.
No, I remember those commercials. Where everybody in the building would just stop and go like that. Yeah.
Right. Yep.
But so today, what we're talking about is we've got some ISM numbers that came out the other day. So we're going to dig into those, and we're going to dig into some other data that Mr. Kingston that John has recently brought to light on a couple other shows that are very interesting and very telling about the health of the trucking industry, particularly small to medium-sized fleets, I believe. But we'll get into that in a little bit. So what I'd like to do, Anthony and John, is kind of set the stage of where we're at, right? So we're in this recovery. It very much looks V-shaped from all the trucking data right now. But is that sustainable, and what are the other numbers telling us is kind of what we want to go to. So if we can throw up a chart here real quick for everybody to see. I'll go through these real quick, and we can comment, guys, jump in when you want to. But what I'm looking at here is year over year. This is year over year, and let me get this to the right size. Sorry about this. Outbound tender volumes. Okay, so this green mountain right here, this is this year's. Okay, and this is the Memorial Day after Memorial Day peak, and then the 2-day drop that we've seen. The yellow is 2018. This darker green here, brighter green, thicker green here is 2019. And you can see that our post-Memorial Day peak this year is actually above the peak season in 2018, which was out of control in the midsummer months, right? Now, it has dropped 2 days, but that's not uncommon. If you look at the trend post Memorial Day, you always see this dip for about 5 to 7 days, and then it slowly starts to climb up. So this is not that crazy. Now, moving on to by mode, and let me change this to larger fonts here real quick so people can see this a little bit better, hopefully. Here we go. So you can see that all modes are seeing an increase in volumes. Outbound tender volumes, or not modes, but all length of hauls. So city, local, short, medium, tweeners, and long are all in on the game, and you can see the different ones here. This chartreuse, I guess, is that chartreuse?
I'm going with it.
All right, we'll go. Or is that fuchsia? Is that fuchsia?
No, I think it's chartreuse. I think you're good on that.
All right, we'll go with chartreuse. There's your long haul, which is certainly the vast majority as it usually is, and it's still skyrocketing, but so is everything else. Now we look at our volumes by flatbed or by reefer and van, and you can see that they're moving pretty much in tandem here, but van is supporting things. So it's not just all produce that is making this happen. And we look at our OTRI, and there's a hot mess right there. Let me stretch this out to 3 months. Outbound tender rejections. You've got again, you got flatbed in on the game. You got dry van, and you've got reefer. All going up. So it's not just van, it's not just reefer. You got flatbed going on here. And then if we look here, did I lose? There we are. Canada's in on the game. There's Canada's outbound volume. and the border crossing trucks border crossing are up. So V-shaped recovery's on, boys, right? Pop the champagne corks.
I don't know, Vincent.
What do you say, John?
That's a little early to be popping champagne corks. One interesting number that we don't have, but we'll have, about 16 hours from now, will be the unemployment numbers. They're coming out tomorrow, and we'll look at the trucking numbers last month. In April took a gigantic decline, far and away the biggest they've ever done, at least the biggest back since like 2008. And those numbers will be out tomorrow. We're going to push those out on FreightWaves.com immediately, but we'll also get a little more granular figure on what was lost in April. You get the broad number for the trucking and warehousing sector, and then a month later they kind of break it down by activities, so you can see how much of it was truck drivers, how much of it was, let's say, back office type of thing. But anyway, that's an important number coming out tomorrow.
It is. Now, we got some unemployment today, right?
We had jobless claims.
Or jobless claims.
Yeah, we got jobless
which
claims.
would indicate unemployment, which comes out tomorrow.
Yeah, and there's been some kind of dichotomy between some departments because they have different methodologies and different ways of classifying, unemployment, jobless claims.
Right.
Or ADP has one that goes out. But like John Kingston said, the unemployment report tomorrow will give us a little bit more granularity, a little bit more detail into what's actually going on, especially within the industry.
Right. So I'm pulling up another chart here, and excuse me, I double clicked there. I didn't want to do that. So what I'm looking at here is, if we can bring this up. So here's a map of the United States, obviously, and so what I've got is the markets in outbound tender volume is the color that I have here. So the darker blues have more volume, right? And then I have outbound tender rejects as the height of those markets, and I can kind of move this around so you can see what the outbound tender rejects are. But the point of this, bringing this up, is we can kind of see where these volumes are coming from, right? And start to get a little bit better information than just, outbound tender volumes are up there over 2018. Let's pop the champagne corks. Flatbed is way up. That's looking good. Now we're starting to dig into some data sets that can help us a little bit understand what is actually going on. And if you look at this, what do you see from this, Anthony? I see DC-centric markets that are showing the volumes.
Right.
And that would lead us to believe, if I'm not wrong, John, is we're looking at coming out of warehouses. We're looking at e-commerce, consumer driven, down supply chain driven, downstream supply chain driven volumes. Would you concur with that?
Well, let's note that this morning, or I guess late yesterday, FedEx announced a series of surcharges on pretty much all of its shipping. Kind of complicated. I can't give you one number, depending on the type of shipping it was doing, but they were following UPS. And interesting comment by Amit Malhotra of Deutsche Bank saying, with the explosion in e-commerce, yeah, it's great for these companies, but that last mile is still expensive. That's still the biggest burden. And by putting these surcharges on, they're hoping to make it a little more profitable. You get the sense that maybe the cost of the final mile we're meaning that the explosion in e-commerce were not necessarily showing up on the bottom line, and they're hoping that the surcharge will. But if they think the market is enough to handle that, I know that Deutsche estimated that the UPS surcharge increase about 2 weeks ago amounted to about 6%. When you figure it all out, and that they figured FedEx was about the same. So, 6% is a pretty big move in a period that supposedly doesn't have a lot of inflation. So that's I can see that where that number might line up with some of the data that you're showing now from the distribution centers.
Yeah, so final mile is absolutely a very expensive proposition within logistics, and so the sudden surge or the uptick in that would exacerbate those on the bottom line, right? Or the effect to the bottom line.
Right.
Gotcha.
Yeah, you have to think that these surcharges will drop, kind of right to the bottom line at FedEx and UPS.
Yeah, I mean that's the goal for them, right? So when you're looking at this as well, you start to see some of these blues start to pick up over here in some of the industrial sites, which would indicate that there's some industry coming back on, right? So you can see that. Obviously not as strong and as dramatic as those that are DC-centric, but you are seeing volumes in what you would consider to be the manufacturing zones, correct?
Yeah, I think we're looking at industrial production. We're looking at manufacturing. It's going to be more prevalent on the East Coast compared to some of the West Coast activity. And you're exactly right. When we're looking at, East Coast, even Midwest, those are known for being manufacturing hubs more so than what we've seen on the West Coast. And there is indeed, it seems to be a little bit more activity, but with the latest ISM numbers, it's
You want me to bring up the ISM numbers?
Yeah, we can jump into the ISM numbers here.
Hold on, I think it's the next one down. Here we are.
Perfect. With the latest ISM numbers, just showing the overall, outlook for manufacturing, it's still in contraction. So we have this amazing gauge here, or panel of gauges, I should say. And
every gauge I could think of, I threw up there. I'm just trying to impress you.
All of them. And so what we could see is that they're all pretty much either at lows or near historical lows, except for, of course, inventories and supplier deliveries.
And that's an excellent point. If I could just interrupt you for a second, because it's my show.
Please.
Is when we're talking about this recovery, we see the OTVI way up and trucking volumes going in. What is it being driven by? Our previous numbers, when we were talking about ISM, they were creating new 52-week lows.
Right.
So it was not production that drove what just happened.
Right.
Right. As Zach Strickland, our director of freight market intelligence, spoke about earlier today, and I think he did yesterday a little bit, but we certainly have had discussions around the office about it, is that he believes that, and I think he's right, is the preparation for industrial startup is supporting some of those volumes, a priming of the pump, so to speak.
Yeah, you need equipment. And so even before you put certain things into production, you need to, like Zach said, prime those areas. And so when we're looking at just the overall ISM, Purchasing Managers Index, that came in at a 43.1. And so that is an actual a whopping 1.6 increase from last month. So it's not a huge increase.
It's not a huge increase.
No, it's a blip up.
It's less terrible, as we talked about earlier.
Less terrible. It's exactly right. It's less terrible. So we see that
I think,
increase.
John, did you have something?
I mean, I just, and when I think about the economy, I think of two big sectors. If you're going to, there's talk that tomorrow's unemployment number might be 20% nationally. And if you've got 20% unemployment, and then out of the energy sector, you've got an industry that, yes, the price of oil has started to recover and it's nowhere near what its lows were. But at the same time, the shale business has been severely hit. And you've got the companies are determined to not go into a full-blown production again, and they want to return cash flow to their shareholders, or at least show the banks. You're not going to get a kick out of that industry too. I just wonder where this any kind of a surge in industrial activity. What sector is it going to come from? I see cars and energy as being significant drags. So, I'm glad they've laid it all in to get ready. But where's the demand coming from?
Yeah, it's a solid point, and also, two solid points. Where's it coming from, and do these metrics give us the ability to go into those different sectors, Anthony, or do we have to wait for the tangibles to come out to see that?
The tangible results from industrial production, of course, will tell us a little bit more information.
Yeah.
And the two usually move and sync with each other.
Gotcha.
But one of the great things from the ISM report is that the respondents and the good folks at the ISM do break out which industries had expansion, which ones contract. And so the manufacturing index here that we have is broken out into 18 different industries. And so real quick, while we have this chart pulled up, I'm just going to talk about some of the ones that were experiencing expansion over the last month. And so when we see over the last month, the ones that did experience expansion or growth were furniture and related products, apparel, leather, and allied products, food, beverage, and tobacco products, paper products, wood products. And so these were some of the areas that saw growth. And if you think about furniture, if you think about apparel,
so couches, tobacco, alcohol, and toilet paper, where's the leather come into that?
I don't want to know. But when we think about all of this,
Yeah.
these are all consumer-related products. These
Yeah,
are
those aren't the
downstream.
ingredients for a Mercedes-Benz.
No. And so these are downstream. And
Yeah.
so even though it's manufactured at a large-scale, wholesale manufacturing level, these are very much still a little bit further on that downstream, because when we're looking at things that contracted over that same time period, we're seeing fabricated metal products, machinery, transportation equipment, primary metals, petroleum and coal products, electrical equipment. So things that usually go into capital goods that are expended by companies and go into factories. And so those are a little bit higher upstream, and those things are still very much in contraction. So that blip up that we're seeing, even though it is a movement in the right direction, they're still a little bit further along downstream in comparison. We're looking at what's growing and what's contracting within the latest results of the ISM PMI.
So this PMI's got all of that baked inside there. So what you're telling me is the PMI is good, but then you need to know you need to break it up further to find out what industries are actually being affected there, correct?
Right, yeah. So it outlines it within it. I don't think they actually release those numbers by industry, but they do outline which industries either contracted or expanded.
Gotcha. And so, and to both of you, John Kingston and Anthony Smith here, when I look at those and see which ones expanded and which ones didn't, what I see expanding is those that would be kind of the catalyst to start the engine to get it going, and then it's up to the engine to fire off and then get the cycle going, the circle of life of freight, right?
Circle of freight. Yeah, when we're looking at that, especially on the manufacturing front, I mean, we're going to need to have, like Zach Strickland said, Director of Freight Market Intelligence said, we're going to need to have those goods in line. We're going to need to have fabricated metals. We're going to need to have certain aspects to machinery and components put in place, because there's many aspects to transportation. When we're looking at new orders, those goods have to come into those assembly locations. Those things get made, and then they get shipped throughout the country. And so it's not just a shipment, it's also the transportation of those things that get made. And so very much the raw materials, if you will, that are going to go into that manufacturing. Although a lot of the bulk of manufacturing is still in deep contraction, still at that 43.1 level. So not an expansion just yet, less terrible.
But gotcha.
We see that blip up.
Is there anything else in the ISM numbers we should dig into?
We could do a quick comparison, because I love looking at this with our flatbed outbound tender rejection index, and I'll make that the main. And we are seeing, I'll put this into large font as well. We are seeing that the two moved in pretty much a unison over the last
absolutely.
couple of months, and when we're looking at this, I think the flatbed and the manufacturing, although it's still in contraction, and flatbed it's recovering, but it's still pretty low. That's a low tender rejection number for flatbed.
Oh yeah, it's nothing to get excited about.
But it's better than it's less terrible.
It's less terrible.
And so similar to the ISM PMI overall manufacturing index, it's less terrible. Although it's a movement, the bleeding has stopped. The contraction has decelerated, and so I think that's a positive sign. But as you mentioned earlier, is this sustainable? Is the demand there? And that's going to be really, really crucial for any sustained rise, especially when it comes for flatbed and really anything that's upstream coming downstream.
Yeah, agreed. And in my mind, what I'm thinking, and I'd love to hear your thoughts, John, is it's all about timing. I mean, we talked about the auto industry, right? And you had to have Mexico and the U.S. kind of lined up together in order to get that start off, because they're so intertwined. The consumer and manufacturing and the economy obviously are intertwined, right?
Right.
So getting an industry going and getting things moving before consumer confidence dies and before the PPP runs out and becomes a life-sustaining thing and not a stimulus thing,
right,
is key.
And there's some news on the PPP front. Last night, the Senate approved by unanimous consent a bill that was passed in the House had made some significant changes in PPP. The most important of which was, it was supposed to be an 8-week program, so it was going to cover your costs for 8 weeks. Now that can be up to 24 weeks. Now that doesn't mean that you're going to suddenly get 3 times as much money. Whatever money you've gotten, you got. But if some companies were apparently having problems showing that their employment costs were adequate, 75% of the loan were adequate enough to pay to get loan forgiveness. So what they do, because some of these businesses weren't open or they were under some kind of restriction. So what this bill would do, and it's expected to be signed by the president, is it will extend that time out to 24 weeks. So if you can, let's say you got $200,000 and maybe you surprisingly only had $50,000 worth of employee costs in your first 8 weeks. Now, if you can show that you paid out more, but it's over 24 weeks, you'll get loan forgiveness. The other thing too is it was originally that you could only spend 75%. You had to spend at least 75% of your loan proceeds on employee costs. That's down to 60. So that'll help some companies with mortgage payments, whatever, if in fact their employee costs never really came up to the level that they thought. So this is considered a sort of significant step in allowing the PPP program to give a little more support. The reality is they've approved about $650 billion in authorization, and the amount of loans they've given out are less than $550 billion. There's been a lot of problems with it. Even though it's sold out the first round very quickly, the second round, companies looked at it and said, I don't know if we want to do this. The SBA has been passing down all sorts of amendments to it. Now you've got this. So, there's still over $100 billion in PPP money out there. I think when you look at the numbers, it looks like the trucking sector probably didn't get its fair share for whatever reason. Its percentage probably should be a little higher. So it looks like it's going to be a little easier. So let's hope that money gets used and helps to kickstart the economy.
Interesting. What are your thoughts on that, Anthony? My immediate thought is yay, but also does this delay the inevitable for some?
That's a huge one. Does it delay the inevitable? And so we're going to see, of course, a fallout of smaller mid-size that aren't able to quite hang within the industry, and not just with transportation and trucking, but throughout the entire economy as a whole. And that is what I'm really going to be curious to see. Does this delay the inevitable? And where does this what does this do to everything? Because when we're looking at the initial brunt of the coronavirus, that really kind of exacerbated a lot of trends that we saw initially when we looked at small mom and pop businesses kind of going out of business. PPP kind of helped save some of them, but not all of them.
That's right.
And so when we're looking at this expansion, just as you mentioned, I'm wondering, does this delay the inevitable? Yeah,
and John, I mean, we were talking to on the midday market update today. We had Jason Miller, Associate Professor Logistics at the Eli Broad School of Business, Michigan State University. And he's expecting to see, even well into the recovery, a growth in bankruptcies, and one of those, and one of the underneath that is this PPP is propping up businesses whose business is down and whose business is going to be down even during a recovery. With excess employees, they're supporting more employees than they need right now, obviously through the PPP, which is theoretically a good thing. But then as business comes back up, maybe they only need 60% of those people, and so they can't repay those loans, or the business is just not there. They've been propped up to live for another 6 months, but then die on the 7th.
Well, remember something about the PPP. If you can show, according to the law, now it's 60%. If you can show that during those 24 weeks from when you got the loan, that you spent 60%, at least 60% of it on employee costs, and they review the loan, they say, okay, you're cool, you met you met all the standards, the loan will be forgiven. So the loan itself is not going to help put anybody out of business, paying the loan, because the loan presumably will go away.
No. But what I'm saying is that
they'll go out of business anyway.
Yeah, that's what I'm saying.
Maybe PPP kept them alive. and then they go kaput regardless.
Yeah, regardless of the PPP, they were going to go out. That's kind of the thought. They're just giving a lifeline that's going to keep them in business for 4 or 5 months and then die anyways. Even during the recovery is kind of the fear there, and kind of along those lines, we've got 5 or a little bit less than 5 minutes left, John. But what I thought was interesting, it would be good for this audience, is talk a little bit about the BMO numbers that you had brought up the other day, the impaired and write-offs from BMO on the transportation industry. I believe it was mostly small to medium-sized fleets.
Right. So BMO is the former Bank of Montreal. About 5 years ago, they bought GE Transportation from GE Finance, so made them a major lender to the trucking industry. They admitted in their first quarter earnings call the business is tough. They didn't talk about it that much in the second, but the numbers were there. And so the write-offs, when they write off a loan, essentially they feel that there's no chance of collecting. That went out to, I'm looking at the numbers now, that went out to Canadian $35 million from $25 million sequentially last quarter. And then they have a category called impaired loans. Certain criteria get met, and then a loan is considered impaired, I guess. Late payments, lack of payments, whatever, and it meets that definition and becomes impaired. That moved out to 189 million from 164 million. So, these are significant increases that show that everything is weak. But on the other hand, from the perspective of the companies that are going to stick around, the companies that have the write-offs are representing companies that are probably out of business, or they're so weak that that BMO figured they're never coming out of, they're never going to get paid. And then the impaired loans are a sign of a lot of companies in trouble. And, these are some of the numbers that point to what a lot of people say, that by the end of the year, we're going to have a real capacity squeeze. So that's a quarterly number to look at. We'll wait another 2.5 months for the next one. But it's certainly, I think, a data set that's significant.
Yeah, I would think so, Anthony. I mean, it's thank you, John. It shows you the health of the industry, and I believe it is the smaller to medium-sized fleets that are there. So there's a significant portion that have gone,
right,
and there's a significant portion that are in danger,
right,
and that's not good. I mean, if they go out of business, it helps those that are still in business because they get better rates. But it could also be detrimental to the recovery if you can't move goods, like air cargo is seeing right now, right?
Yeah. And the other thing I'm curious about, maybe I'll be completely off about this, is does this just kind of shift things a little bit? As more mid-sized carriers or fleets kind of go out of business, do they just get absorbed? Is it just kind of reshuffling of sorts? And now the big just get a little bit bigger, because that's definitely what we're going to see on the retail front. We're looking at large manufacturing, large retailers.
Yeah, are there going to be are the big guys going to benefit from this?
Right, because Amazon, Costco, Target, Walmart, they're going to be all right. They're going to be just fine, and really absorb any kind of losses that smaller and mid-sized companies have.
No,
so
they really
interested
are.
To see how this happens and plays out with transportation as well.
Right. Yep. So here we go, guys. We only got we got about a minute left here, John. Go ahead with your thought there.
No, I was just going to say, it always fascinated me about trucking, which I'm still relatively new to, that the barriers to entry are so low. Like, why do you acquire a company? Why can't you just organically grow your way into a company that's a company's market? But obviously, some companies look at it and they say, we're better off buying rather than building.
Yeah, that's very, very true. Very, very true. So, hey, if we could bring up the chart to the screen here once. All right, so lightning round, I guess, maybe.
Let's do it.
Here we are right now, John. What do you think? With all the numbers that we're looking at right now, where do you think things are going over the next couple months as far as the freight markets?
I would say a slow recovery. I think the economic conditions are so weak. You just don't snap back from 20% unemployment. And I think it's great that we've got a nice little spike here post Memorial Day. I wonder how much of that is sort of restocking of inventories that just doesn't have any legs.
Right on. 10 seconds.
All right, I'm going with a steady moderation. So it's going to be a steady moderation after this. I don't expect it to really kind of skyrocket anymore.
Yeah, no, I see it coming down into about this range, 10.3, 10.2, right in this range.
Okay.